So the first question that I wanted to kind of jump right into, and I actually shared this with people that are part of our mastermind and our wealth hackers, but I got access to all the different top kind of links, okay? And I know, Anthony, something that resonated with me a lot was that you said, look, Scott, we get access to kind of the top banks reports. We manage $600 million plus minus just short of 10 billion Rand, if I've got my maths right in terms of the overall process. And we get access to this knowledge, and then we synthesize it in terms of what is happening. I don't know, Anthony, if you just want to talk to that process, because most people, even though I sent everyone these links, don't even have the time to read 19 different reports, and more importantly, to even figure out what to do with it,
Yeah, no, sure. This is a comprehensive list. Believe it or not, our list is probably a bit more comprehensive than this. But really, like you say, Scott, it's about digesting the information, and it's about understanding where each different research provider is coming from, what their motive is. Is a very strong thing to consider, and I would kind of urge anyone that looks at these things to try and understand the motive of the research provider, because you can sometimes come across research that's a bit tainted when guys try and push their own agenda. And believe it or not, it happens in the banks, it happens everywhere. So for us, it's about digesting, it's about understanding the different points of view, and then using our own knowledge and kind of finding a middle of the road that really encompasses is everyone's view. So that's what we like to do. Like you said, it's a lot to wade through. But you generally start to pick up these themes, and you'll start to see, is everyone aligned with one direction, or are we starting to get some divergence in those views, which really signals to us potentially tread with a bit of caution. When one guy's saying buy, other guys are saying sell, you need to understand why.
So that exhaustive list that you put there, interestingly enough, Anthony read probably all of those reports. And whilst he was enjoying his New Year party, I sent him a message to say, please summarize all of those reports, have a look at them and find the common points and give us a synopsis of the theme, which he did. And we actually sent out in January. So we have read a lot of those reports.
No, and I think that's the whole point, Garth. That's what intrigued me when Anthony mentioned it. And that's sort of where I want to start. And Anthony, I've got those graphs available. You must just shout when you want them, the different graphs that you sent me. But I'd like you to kind of, and whether I've taken the screen sharing off on purpose so that people can actually see you better. But my point being is that, what is the synopsis of the market conditions for 2023? What are your kind of takeaways, etc.?
Yeah, good question. $1 million question, I guess, at this stage. I think for me, it's important to understand where we've come from to kind of paint a better picture as to where we're going. So a quick recap, the last 10, 15 years have been an environment of extremely low interest rates and low inflation. Which favors some companies more than others, and we've seen some companies do extremely well. I mean, just take a look at some of the FANGs, which is your Facebook, Apple, Netflix, Google, and just see their share price or their return over the last 10, 15 years. I mean, it's really been astronomical. We then kind of entered this COVID environment where there was a lot of uncertainty in the markets. The US dished out massive stimulus checks, and again, it was a drop during March, and it was off to the races for the rest of 2020. Now, a lot of these things have long-term implications, and it takes a while for this to kind of wash back into the markets and really for the market to digest and for the indicators to start flashing red. And this really all came home to roost in 2022. We had high levels of inflation. We had interest rates that were low that really needed to start ramping up to control this inflation. Throw in a war between Russia and Ukraine, and you've got quite a big recipe for disaster. I mean, add China lockdowns to that, and that kind of never-ending story throughout 2022, and you're really starting to paint a kind of perfect storm. So that happened in 2022. And the reason why I bring that up is because those are all important risks and factors to keep in the back of your mind when looking at 2023. We saw an interesting start to the year. Certainly something that I haven't seen in a very long time. You had December, quite a bad month for markets. I think most markets were down around 6-7%, and then you almost had first, second, 3rd of January this complete change of switch. And guys, it was almost like they came back from their Christmas holidays and they completely forgot about 2022. It happened that fast. We saw markets gathering steam, some really good upward momentum. And January finished positive. So a lot of guys were left kind of scratching their head because there was no real data that came out that was super bullish or anything that was screaming buy at the time. There was some positive news out of China, which I'll chat to now. But really, that's the kind of environment we find ourselves in now. So looking forward, we would summarize our view as cautiously optimistic. There are definitely some serious risks that are still on the table, but there are some good green shoots starting to emerge. Probably the biggest one at the moment is that China has seemed to come out of their lockdown. They're back at the office, they're back in the factories. That wheel is starting to churn again, and we're getting that supply to the rest of the world that we so desperately needed. So a lot of the inflation that we saw throughout 2022 was what we call supply side inflation. And really what that means is that there's not enough goods to go around for people to buy. So they end up getting into almost a price war, trying to bid on, let's use a loaf of bread as an example. They get into a bit of a price war trying to buy this loaf of bread, and that drives prices up, and it's not good for inflation. So that's one of the risks that's washing out. That's a good thing we've seen. I think the attention for us is definitely on quality businesses that can withstand any potential volatility or wobbles further down the road. When I say quality businesses, I mean those that are cash rich, that aren't running large balance sheets with a lot of debt on them. Debt at the moment is obviously starting to become extremely expensive when your interest rates go up. So you want to see companies that are healthy, companies that are paying a dividend, even if it's not a massive dividend. What it tells us is that if there are any storms down the road, those companies are able to withstand them a lot better. They can slash dividends. They're not going to have to dig into debt and things like that. So that's where the focus is on quality businesses that are sustainable, businesses that have high economic moats that aren't easily disrupted. And then if we move into other asset classes, I mean that largely focuses on equity. If we move into asset classes like bonds, coming off an absolutely shocking 2022. I mean the stats at a stage where I think the worst bond market are out in about 70 odd years, which is saying a lot. So there's definitely value there. Property's looking good at the moment. We're seeing some good yields in that sector. So yeah, it's a stock pickers environment. It's certainly moving more towards an active management style of portfolio management. What I mean by that is really you need to have guys that understand these businesses well, that can kind of cherry pick for you. I think whilst the indices will still do well, I think an active manager can do even better. You got to remember that these indices by definition are just loaded with, let's use the S&P 500. They've got the top 500 companies. So you're not getting that active manager that can overlay a sense of analysis into it. So that's where our mind's at, Garth. I don't know if you want to add to that.
No, I think you've covered most of the themes. I mean, I would talk on a more generalized level later on, but yeah, I think that does give us one thing I want to mention. I mean, that slide you put up is actually brilliant, because we get so focused in what is the 2023 outlook, and the one, if you go back to the emotions, Scott, right in the beginning where you showed negative emotions around markets and that. And I just want to talk about this because this is what we face. Now, you must know when you have a 2022, that threat, that side there, an investor becomes an 8-year-old child in a supermarket that can't get the toy. It's almost an irrational, no matter how much he logically can, source the information. That's where they go straight away. Now, when you have a January with all the information flowing there, you've got to be very careful of what we call false starts. So now in January, you've got everybody who in December was on that side, and now everybody on the right is going, the world's changing. So, and when you look at those, all those economic reports and outlooks that you put there, you've got big banks, big research banks, one saying 100% is going to be a bull market. You've got another saying it's going to be a deeper recession than we think. So to summarize what Anthony was saying, we've got a recessionary environment, but what we are analyzing and what we are seeing as an outlook for 2023 is that this recession that everybody has been fearful of has been a much softer landing in January, and we believe that softer landing is going to carry into the 2023 theme, that volatility will remain, but don't for 1 second believe that the problems are gone. So we believe the soft landing, the inflation, the interest rates, all of the mechanisms to drive a bull market are going to take a little bit longer than people think. We're only going to see inflation, predictions coming down in 2024, in our outlook on inflation. So a lot of the stuff that we see is going to unfold in the latter part of this year. And when we talk about a soft landing on the recession, and when we talk about, cautiously optimistic, what does that mean? And when we bring up that asset class chart of ours and we look at the actual numbers of how some of the assets have fallen, you get kind of this, the world fell by 20%, 18 to 20% in dollars last year. And we believe...
Will you guys just tell me when you want those slides? Because
we'll bring it up when you talk about the asset allocation side. But we actually feel that we're not going to see those all-time highs. And I want to make that remark again. This is not advice. This is a view that we would build portfolios on. So our view is very much that the emotions will drive volatility. The general sentiment is not like as positive as people think it is. There's still a lot of negative sentiment. There's still a lot of concern, and there's still a lot of themes to play out. So looking at the global benchmark, the MSCI, for example, we're quite confident, even with the very strong start, that the world is likely to produce 3/4 recovery of the loss that it had. So I'm talking if the S&P 500 was down 18 or the MSCI was down 18, we expect 10 to 12% positive returns, 3/4 of the recovery, if the current themes continue to play out like this. And we see inflation actually really being under control, which we believe it is. And we see that outlook for 2024, the inflation numbers dropping, but global GDP remains very muted. And it's in that we see the sectors of opportunity. And why I bring up that graph of emotions is what takes you from the red zone back to the blue is not worrying about what actually is going to happen this year. It's by having a proper financial plan. It's by having proper insight to see the opportunities and being able to think clearly about the long-term plan. Okay. And that's where you remove temporary and damaging, behavioral finance decisions. So that's just a caveat I want to add to when you have an outlook of 2023 years, there's opportunities, but those must fit your plan. They must fit the family that we are managing. It must fit one of the several portfolios we might have in there. So yeah, I'm just bringing that into context as well. Sorry, I was a bit long-winded there.
No, I love what you just said there, because I think it's absolutely critical. If I've learned one thing in 25 years, again, it's not this panicking up and down. It's like, what's your long-term plan and kind of sticking to it. So I'm very glad that you reiterated that in terms of that process. So let's move on to the second question.